As quick as this series may be, each video, I'm really enjoying it. I'm coming across companies that even I didn't really know too much about. So let's continue with the Compass Group, Lloyds Bank, Haleon, Prudential and Experian. Quite a vast array of industries, so this should be good. Right, Compass Group. Now, they operate as a food and support services in North America, Europe and internationally. We can see they're currently trading at £19 with a market cap of $32 billion, up 26% in the last 12 months. And it seems that they've had a high of about £19.50. And then in terms of lows, about £15 would be the lower end of it, so about a £4 margin in the last 12 months. We can see here that value, they scored 2 out of 6, but when it comes to future growth, past performance and financial health, they score very well with an excellent balance sheet. Dividend sits at 3 out of 6. We'll have a look at that there. The only risk analysis popping out at the moment is insider trading, or well, insider selling, sorry, not trading. We'll see what could be the cause of that. Let's go. Valuation. Okay, so 29.5 PE ratio. All right. In terms of their peer average, about 14, but some of those peers aren't exactly in the same industry. I wouldn't say the Compass Group are exactly like Domino's or Greggs for that matter. Let's go down to future growth. The projected 13.5%. Not bad, I must say. Let's see their free cash flow sitting around 919 million at the moment as of September there. The industry is about 30%. Hospitality is forecast to grow, mainly, coming out of COVID as things recover and, barring the whole economic downturn and recession at the moment, things are projected to hopefully get better. Down to past performance, minus 20%. You can see that they were growing quite modestly all the way to the pandemic starting in 2020, where they went into a bit of the minus numbers on the profit margin, but they have since recovered to actually just higher than pre-pandemic levels with a profit margin of 4.4%. Financial health for them, pretty equal on the assets and liabilities. Short term, long term, it's covered quite nicely. In fact, the short term is the only thing they don't score highly in. They appear to be growing their equity against their debt quite nicely to 67% over the last couple of years. Cash and equivalents, again, also growing. Good to see. Debt's well covered by operating cash flow, as is interest payments. Nice. Let's go to dividend. They scored 3 out of 6 for this. That's because it's not too notable, not too high, not too stable. Although it is growing, and their ex-dividend date is the 19th, so that would mean you'd need to share on the 18th of January in order to get the dividend. 1.66%. Right, how's that stand? Industry average, a bit higher. It's forecast to grow, so let's see. So they were consistently growing their dividend per share over at least from 2020. They completely cut their dividend for the next 2 years, and it recovered there back in March of 2022, growing again, and it's projected to reach pre-pandemic levels in September of 2023. Ownership. There's the insider trading. 2,800 shares of 52,000 for a company at about 32 billion market cap. That's not too much to worry about, I would say. Institutions sit at 87%, general public at 12%. Top owners are Artisan Partners Limited, BlackRock, FMR, and then Vanguard. Right, who's next? We have Lloyds Banking Group, another bank based in the United Kingdom. They appear to have a decent value at the moment. Okay dividend, good strong financial balance sheet, past performance and future is where it's a bit lacking. We'll look into that down the line. Currently you can pick up a share of Lloyds for 46 pence. They're up 3.2% over the last 12 months. Lows of about 41 pence, highs of about 54 pence, 50 pence. Market cap 30 billion. Let's see how they sit. Down to valuation, they sit at 7.8 in the PE ratio, and we can see here that they're undervalued by 55% on a DCF, discounted cash flow model. That's good to see. Right, future growth, how's it projected? 1.9%, pretty modest, nothing major. What about free cash flow? Yeah, I forgot this is a bank. Okay, we'll not look too deep into that. We can see they're projected to grow modestly into 2022. I think it's December is their next earnings call. It's projected to be pre-COVID levels, so we'll see what happens there. Past performance 4%. Nothing too major there. They seem to have been puttering along pretty nicely. Financial health for banks, it's always pretty strong. Short term, 353 billion to 573, and long term, they have a bit more in assets, although it is a bank, so you can see by these graphs they don't play the same game as a lot of other companies. Let's see. What's the only bad thing? Allowance for bad loans. They have a low allowance for bad loans, 52%. Something to note. Down to dividend, we have them sitting at 4.65%. Not a bad yield. A bit higher than the industry average, not in the market top 25%, but it's forecasted to continue to grow. We can see that they were going quite strong all the way to the pandemic, where they cut their dividend for a year before recovering it. It's projected by about 2024 it is to reach close to pre-pandemic levels on the dividend per share. Its yield about 4.7. Let's go down to ownership. Let's see who institutions followed by the general public for this one. Okay, let's see. BlackRock, Vanguard, BlackRock. Nice. All right, so Haleon is our next stop. Now, they don't have a year on the books at the moment. About to sneeze there. Currently trading at £3.18, 29 billion market cap. Low of about 20 or £2.47. Now, these guys were actually spun off from GlaxoSmithKline GSK, which is why their market cap drops substantially, but you got shares for Haleon if you own GSK shares before a certain period. I got them, and I think I sold them at about £3, and they dropped the gain down to about £2.47. They aren't a proven company as of yet. I believe their balance sheet, and they've got a lot of pros going for them, especially the products that they provide. The only issue being they have yet to pay a dividend, so they, with no track record, it's hard to really know on this one. Valued at 2 out of 6. Future growth is pretty good for them, and financial health isn't too bad. They've no risks as of yet. We just don't know where their dividend will sit, and we'll have to wait and see on that one. Down to valuation at a 21 PE ratio. Earnings 1.39 billion to their market cap. We can go down here to their share price and see that they're 11% undervalued at the moment on a DCF model at about £3.57. On the growth, they're currently sitting at 11.9%, projected to grow quite nicely into 2023 and 2024. Of course, don't trust these as 100% a given. Economic conditions and other things could be factored in. They are mainly their forecasts. That's what they are, and should be treated as such. They currently have about 1.6 billion free cash flow. Down to past performance, they were growing about 4.6%. Okay, well, it's from 2020 to about 2022, so not a lot of data. That's the only thing. Haleon has a bit of time to prove itself. I'll be keeping an eye on it into the coming years, certainly, because I was an owner of GSK. I don't have the stocks at the moment, as I want to see how both companies perform in the coming years. Short term, their assets cover their liabilities, as is long term. Not too bad at all, with a good 38% debt equity ratio. Now, their debt coverage isn't well covered by operating cash flow, but the interest coverage is at 19.7. Right, let's go to their dividend, where they score 0 out of 6, 1.95% forecasted. Now, that's, of course, later in December. We'll have to see what exactly. Oh no, it's December 2023. Does that mean? I think it's this. Yeah, I think it's this December. We'll find out. It's projected to be about 2.1%, 2% in that range. Of course, time will tell. We'll have to see. Ownership. Who owns most of these? Public companies at 57, institutions at 41. Whoa, Pfizer came in with the big old 44.8% ownership. So with all their, I would imagine with a lot of their COVID vaccine profits, they bought into Haleon. I suppose that could have been, I could say that's probably a really good move. 13% is their previous owner GSK. Dodge & Cox, Vanguard as well. Okay, something to bear in mind. I'll be looking at Pfizer once we go into US stocks. Next, we have Prudential. Prudential are a provider of life and health insurance, retirement and asset management in Asia and Africa. Currently, 3 out of 6 in value, 4 out of 6 in future growth. So, reasonable growth potential and fair value. Okay, financial. They're a well-rounded company. We'll have to see on the dividend side of things first. Pay ratio 28.9. Let's go down and see. Currently at 36.9% undervalued on a DCF model. Okay. Future growth 24.6%. So they had a wee bit of a drop there. Actually, a major drop into June of 2022. I'm not too sure why their revenue has plummeted that much. I would imagine there's something else to it, because again, it's one of those industries. It's life insurance. You know, insurance companies, their revenue mightn't be exactly as it looks. Free cash flow 754. You can see it's projected the return back to sort of similar levels in 2023. Now let's see past performance. They were doing really well up to 2018, then a wee bit of a slump into 2019 or 2018. Again, built it back up, and over COVID, like a lot of companies, it went down a wee bit. Financial health, where do they sit? It's not too bad. 34% debt equity ratio. Their debt isn't well covered by operating cash flow, but the interest payments are, and they have more cash than total debt, do they? 6 billion in cash. Nice. Dollars, that is. It changes the currency when you're using Simply Wall Street. Always be sure to keep an eye on which symbol it is showing. 2 out of 6. They don't score. It's not notable, high, stable or growing. It sits at 1.35%. Okay. Well, it was growing dividend per share up until 2019, and they cut their dividend. Now, a lot of companies completely stopped dividend payments. Prudential appears to have simply cut it by about a quarter, or 3/4 it cut it by. It's projected to somewhat recover, but that is yet to be seen. So be sure to keep an eye on that. Down to ownership, so I want to see what their breakdown is. 88% institutions, 9% general public. BlackRock, third point, and BlackRock again sit as the top 3. Nice. Okay, we're on to Experian now. They are a technology company. I'm sure a lot of you are very familiar with them. We could actually hit the About company if you're using Simply Wall Street. Links obviously in the description for you. They provide business to business and consumer services and data services. Okay. I think Experian credit reports, I thought that. So very much in the financial side of things provided internationally. Now let's go to their valuation. See where, well, actually, they're trading at £29 a share, down about 20% over the last 12 months. High of £36, low of about 22.96. Decent dividend payer. All right valuation, good future growth though, and financial health not too bad. High level of debt, something to take note of. Let's go down and see what we can find. Let's see. 2.4% undervalued on a DCF model. 12% growth, okay, that's not too bad. What about free cash flow? 1.2 billion, okay, that's definitely something to note. Let's see. Past performance, 6.9% annually. Let's see. That's been growing quite steadily. Even over COVID, did a wee bit of a dip, but nothing too much. They actually came out of it pretty strong, which is rare to see in a lot of cases. Financial health, it says they have a lot of debt, so we'll see short term not covered, long term covered. See, debt is not necessarily an awfully bad thing. Too much debt can lead to problems for companies, but when their debt is well covered by operating cash flow and the interest payments are also well covered, that's, something to consider against, the point of them having a lot of debt. Only 153 million in cash though. That's again something to note. 4 out of 6 on their dividends. Not notable, not high, but it is stable and it is growing. Ex-dividend date January 5th, meaning you would need to own the share on the 4th in order to get the dividend. Let's see here. That's a really decent chart when it comes to dividend per share. They didn't even flinch when it came to COVID. They grew their dividend per share straight through it. That's rare to see. Earnings per share went up a wee bit too. Not bad. Let's go to ownership. To top this off, WCM Management, Vanguard, Massachusetts Financial Services, institutions and general public seem to be the two biggest owners of Experian. There we go. And with that, that is all of the next 5. I want to actually see. We're going on to page 2 now, which means BAE Systems, defence contracts. We've got NatWest, Barclays, CRH and Vodafone. Very interesting pair for the next video. Catch us all over there. Thank you.